When it comes to how investors behave in the market, you discover that the behavior they display is more of influenced by emotions rather than logic or reason. So stock prices may fluctuate based on market sentiment, not necessarily based on the fundamentals of the companies in the market. Just people's emotion will determine the direction of stock prices, particularly in the short term. And so, behavioral factors, play a significant role in stock market investing. Often leading investors to make decisions that deviates from rational, logical choices. These factors stem from psychological influences and biases that can affect decision making. So below are some key behavioral factors that influences stock market behavior, stock market investing. Number one is overconfidence bias. Overconfidence bias. So investors tends to overestimate their ability to predict market movements or select successful stocks. Just like interviewing, most drivers will feel they are better drivers than they actually are. Okay, so investors feel they are very good at picking individual stocks than they actually are. This can lead to excessive trading, taking on too much risk, or ignoring signals that the market is about to take a downward turn. Overconfidence. Possibly a particular strategy worked very well in time past. It may not really work in the future. So overconfidence can lead to severe losses if not tackled effectively. Number two is loss aversion. I don't want to lose money. I don't want to lose money. Loss aversion. So loss aversion refers to the tendency to feel the pain of a loss more than the gains, more than more than the pleasure of the gains you make in the markets. All right. You feel the pains of losses more than the pleasure that you derive from gains in the markets. This leads investors to hold on to a losing stock for too long, hoping that the stock is going to recover. So, and they want to avoid selling at a loss. They know if they sell, they're going to sustain losses. They say, I'm not going to sell. If I sell, I'm going to lose money. So that fear of loss will then make them to hold stocks. The price is going down, they will refuse to sell because they don't want to incur losses. It is called loss aversion. Number three is heart behavior. Following the heart, following the crowd. All right. The Bible says we should not follow the multitudes to commit evil, But this heart behavior is very common in the stock markets. Investors often follow the crowd, buying or selling based on what others are doing, rather than conducting independent analysis. You need to be a contrarian investor. You don't follow the crowd. Because when it comes to investing is not a democracy where the majority is always right. Sometimes the minority could be right when it comes to investing. This can create market bubble or panic selling during market correction. So don't follow the heart. Be rational, be thoughtful, be logical when it comes to your investment decision. Don't follow the crowd. It takes discipline, and one of the success factors when it comes to investing. Number 4 is anchoring bias. So investors may anchor their decisions to relevant past information, such as the price they originally paid for the stocks, or or maybe a previous market high, leading to poor decision making. So when it comes to anchoring, you have a particular price in mind. You say, well, I bought this stock at this particular price. You anchor your decision making based on that price you bought. Okay. If it doesn't go beyond this particular price, I'm not going to sell. Even when the price is going down, say, well, it must come to this price and go beyond, or else I will not sell. So you are being affected by this psychological bias called anchoring, and it can lead to poor decision making. Number 5 is confirmation bias. When it comes to confirmation bias, investors will look for information, seek information that will confirm what they already believe, that will strengthen their opinion, and they would psychologically filter anything negative, anything that doesn't really correlate with what they believe in. All right. So they ignore all contrary information. So this can lead to poor investment decisions and missed opportunities. Just psychologically, even when they're carrying out research, they tend to pick figures, circumstances, news events, factors that confirm what they stand for, what they believe in. And they will psychologically filter out every contrary opinion, contrary point of view, which is not the best. That's why you must have somebody around that will act as the devil's advocate, so as to overcome this confirmation bias. Number 6 is mental accounting. Mental accounting here, investors may treat different investments as separate accounts rather than considering their overall portfolio. When you talk about the portfolio, a portfolio consists of different stocks. All right. But then you treat these stocks differently, individually, instead of considering them as a portfolio. That's what is called mental accounting. This can lead to substantial decisions, suboptimal decisions, like holding, onto a losing stock while selling, a winning one prematurely to lock in gains. That is it. You become enamored, you become attracted to a single stock or stocks in the portfolio and wouldn't want to sell even when you are losing, because you are treating these stocks on individual basis rather than treating them as part of a portfolio, considering the overall health of the portfolio. Number 7 is recency bias. Recency bias. Investors often give more weight to recent events or trends, leading them to believe that short-term performance will continue into the future, even though the market is cyclical. The market doesn't just go like this. Sometimes it goes like this, it fluctuates, it gyrates. It's never, a straight line graph most of the times. Okay, so don't allow recent events to affect your decision making process, because the events may not really last forever. It will not. Don't be affected by recency bias. You allow a recent occurrence, a recent news, a recent events to keep on guiding your decision making process as if that event will last forever. No, that's what is called recency bias. Number 8 is endowment effects. Investors place a higher value on assets they own compared to similar assets they do not own, often leading to poor decisions like holding on to underperforming stocks for too long. They value what they own and ignore or disregard what they don't own. Even when what they don't own makes better return, they will still have to cling to what they own. For instance, somebody may be holding a shares of maybe a particular company A. You hold tightly to the stock of company A, even when company B and C, companies B and C are doing extraordinarily well, you still want to do what? Keep on holding tight to that the stock of a company A. It is called endowment effect. So you find it difficult to sell and buy the shares of company B and C that are doing very well. Number 9 is availability bias. Investors are influenced by information that are readily available or memorable rather than considering all relevant data. This can lead to the overestimation of the probability of certain events or outcome. So you just base your entire decision-making process on information you can very easily glean on what is called first level information. The second level, the third level information, critical thinking. You just make decisions based on superficial events, superficial analysis. That's availability bias. Deciding based on what news is readily available without digging deep into, other related news to see precisely whether what you believe really counts or not. That's availability bias. You just, you decide based on what you on your news feed. Why don't you go and dig critically into other news sources that may not be readily available to see whether it can confirm or not confirm what you believe. Number 10 is status quo bias. Investors tend to stick with the current investment or strategies, even when a better strategy is available. They say, well, this strategy worked for me. I will keep on using it, even when it doesn't work again. It's no longer applicable. It's no longer relevant. That's what they call status quo bias. Because they are uncomfortable with trying new strategies. They are uncomfortable with trying something new. They can't try something new. So number 11 is emotional decision making. Emotions like fear, greed, excitement, euphoria, pain, depression, anything you can imagine, could drive the markets. It can lead to irrational decision making, such as panic selling in a downturn or chasing, after hot stocks, meme stocks in a bull market. So by recognizing and understanding these behavioral biases, investors can work to mitigate their effects, and potentially improving their decision-making process. And that will lead to what? A long-term positive financial outcome. So please study these biases and understand them. It will help you a lot as an investor.